Less stress, more time, more money. Welcome to the Cash Flow Contractor Deep Dive.
Well, Martin, welcome back to the Cash Flow Contractor. It's good to be
sir.
back in your office, your conference room.
Yeah, I was already here.
You've been here for a
I'm
while.
technically not back.
Well, welcome me then.
Well, welcome.
Thanks.
Khalil.
Appreciate it.
Yeah.
It's good to
Sine
be
qua
here.
non. You know what that means?
No, I don't.
It means without which not. It's a critical element. So without sine qua non, Khalil and our friend Ethan over here, none of this would happen. You wouldn't get the benefit of our combined wisdom.
That's
Yeah.
fair enough.
Sine qua non. We'll start calling you Sine.
Sine.
Yeah.
I like that.
Everybody will just think that's a Moroccan name or something.
Probably. How are you liking this weather?
I like it.
It's
cold.
It's about
cold
30
outside.
today.
Oh, it's colder than that.
Cold than that.
Yeah.
It's gonna get down to like the high is 2 on Monday.
Yeah. Which, our mutual client in Canada up there in Cold Lake, Alberta, Canada, he's just laughing at us. He sent me a picture of the
He's like, I'm out in my shorts when it's 2.
minus 46.8 centigrade. And centigrade and
I think it was
Fahrenheit
like
cross
58.
at minus 40.
Yeah, so it was like
those same
58 Fahrenheit, negative 58.
I got to do the math. I'm going to do the math real quick. Minus
Okay.
48 times 2 is minus 96, plus 32 is minus 64.
We'll have to double check that because I
Yeah.
don't know that we are.
You take Fahrenheit, you subtract 32,
Okay.
divide the remainder by 2.
Okay.
That's centigrade. So if you start at minus, well, here's the check. Minus 40 is the same for both. So minus 40 times 2, we're going the other way.
Okay.
Minus 40 times 2 is minus 80,
Yeah.
plus 32
Okay.
is minus like 48. So, and the reason it's not exactly 40 is it's not really double or half.
Yeah. So I think it's a
5
little
ninths
bit
and 9
less.
fifths.
I bet it's like 55, negative 55.
It's cold.
It's cold.
It's cold.
Well, 15 inches maybe of snow on Monday.
Right.
Or Sunday, Monday.
Sunday or Monday, yeah.
It's exciting.
Yeah.
It's going to be interesting. Yeah, I don't fare too well with the cold, but it's good to be inside.
Yeah. Well, like you say, you got to have a job to take a vacation because there's nothing to compare it to. So
Yeah.
you have to have cold to appreciate the warm, and you got to have the warm to appreciate the cold, and you got to have day to appreciate the night. You got to have night to appreciate the day. So contrast makes life rich.
It's true.
You got to have a bad balance sheet in order to appreciate a good balance sheet later on, right?
Sure.
Absolutely. Seriously, you got to know the score. Ooh,
Got another
segue.
score?
Well, hey, you know where the word segue comes from?
The thing that you ride around.
No. I think it's Latin based, but in Spanish it means to follow.
Oh.
Yeah. I know that because I watched an indoor soccer game when I was coaching, and one of the dads on this little girl's Hispanic dad was yelling at his daughter, "Sígala, sígala, sígala. Follow it, follow it, follow it." Which is not the advice I would have given him. I would have said, "Get it," but
Get
not.
it.
But anyway, she was following it all.
You know, I had a great idea, Martin, about how to figure out how many listeners we have without looking at the analytics, all that kind of stuff. I know a lot of the guys that are listening are probably driving around listening to this. So if you are doing that, just put your hazards on right now, and then we can count.
I'm blinded.
We can count all of the anytime you see hazards on the road, now you know that they're listening to the Cash Flow Contractor.
There you go. Yeah, they're on the side of the road. Speaking of which, what do you know about SpaceX? What do they call it? The satellites they're putting up?
No.
Oh,
You're going to butcher this, but I'll listen.
no. SpaceX has put up 300 satellites already,
Sure.
so that we have worldwide global satellite internet.
Okay.
And it's called something. But Laura, my daughter in Colorado, texted me this morning. She said, it's ruined our sky. If you Google, hang on, we can cut this part out too. Let me see what the name of it was.
Cutting things out.
Ethan, do you know what I'm talking about?
It's ruined the sky in Colorado or everywhere?
Starlink.
Starlink.
Yeah, Google Starlink. And there are these streaks in the sky. And they're doing some kind of maneuver right now. But the sky is changing because there are so many of these satellites up there.
Interesting.
Anyway, she was complaining because she said they're ruining our night sky.
Oh, I see them.
Yeah,
It just looks like a bunch of shooting stars.
it does. Well, that is a camera deal. You're not going to see that exactly, but you are going to see the motion. 300 satellites moving in concert. It's pretty. And did you know they'd already shot up 300 satellites? SpaceX. That's Elon
they're
Musk's
shooting
deal.
up satellites all the time.
300.
Yeah,
Well,
they've been doing it for years.
SpaceX has.
Mm-hmm.
Oh,
Yeah.
well.
It was like 5 years ago or so, maybe more. That
300's a lot, man. That's
Yeah.
one every 3 days in 5 years. If I'm fast math there.
Definitely.
Anyway, that's a lot.
But you can send multiple satellites in one launch.
Right.
So, anyways.
Anyway, okay. Balance sheet.
Well, connecting that to the balance sheet,
Right.
as
Let's
I like
see you
to
do that.
These segues are just so great. All of these different satellites in the atmosphere are causing a lot of traffic in the sky,
Right.
right? And
You're
it's the
working
same
it.
thing
I'm trying to follow here.
when you're an entrepreneur and you start creating all these different businesses, these different satellites, and you start throwing them out there, your balance sheet gets really complicated, and it's just all over the place. And so you might need to focus on the one. I don't know. I'm
I
trying.
know. Yeah, we'll link it together. Maybe we can do that in editing.
Okay, balance sheet. We've been on this series on financial statements. We've done an overview of all the financial statements, why they're important. We've covered the profit and loss statement. Now we are on to the balance sheet. So for the contractor who says, well, what do most business owners, the majority of small business owners, what do they say about the balance sheet? They have no idea?
Well, let's review real quickly. There are 3 financial statements, common
Right.
financial statements: the income statement, or profit and loss,
Yeah.
the balance sheet, and the statement of cash flows. What I've found over the years, and we talked about it in the last podcast, is I've never met anybody who didn't intuitively understand what a profit and loss was.
Right.
They're trying to think, well, this how much is coming in and this how much is going out. So that's a rudimentary understanding, but people understand. Maybe you're born with it, I don't know. But an understanding of how much came in and how much went out. It's a little more sophisticated than that, but at least they understand that. So people understand a profit and loss. Most people that I have that I've worked with or talked with, small businesses, have at least heard of a balance sheet.
Sure.
And that's typically because their banker asked them for one. Mm-hmm. And then just completing the 3 reports, the third report, the statement of cash flows, and talking with hundreds and hundreds of business owners, I can't really even remember ever meeting a business owner who had even heard of it, let alone used it. So those are the 3: income statement, balance sheet, statement of cash flows, and we're on the balance sheet today.
Yeah. And with most business owners not knowing how to look at a balance sheet, they're missing out on quite a bit. Mm-hmm. What are some of the most common things that you see that they're missing out on?
Well, let me back up just a little bit and say what goes into a balance sheet.
Well, no, I want to know like what people like. What are some of the questions that this is going to help them answer?
Well, it is the score.
Right.
Okay,
Right.
It's the score as of a particular point in time. It tells you a lot. And one of the things you and I were talking about before is all of Wall Street, all of finance, all this stuff you've ever heard of is based on the balance sheet and the P&L. Mm-hmm. Okay, so it can get so far and so sophisticated. People get PhDs. That's what finance is, right? You can get a PhD in how to use the balance sheet,
Right.
in combination with the profit and loss, because you need information from both. But they are the score. A balance sheet is what we call a snapshot statement. The profit and loss tells you what happened between 2 dates, like January 1st of last year and December 31st of last year. Between that year, how much did I sell? How much did I spend?
Yeah.
Okay, so it's a period statement. It tells you what happened over a period of time. The balance sheet is a snapshot statement. It tells you how you stand at the moment
Yeah.
that you produce that balance sheet.
Right.
And I mean the moment, because if somebody gets in your QuickBooks and makes another entry and you print another one, it's going to be different.
Right.
More than likely. So, it's going to be different. So it is the score sheet. And to let people kind of understand what that means, there are a lot of accounts on a balance sheet, and each one of them is just like your bank account. your bank account, if you open your app on your phone, has a certain amount of money in it right at this moment.
Yeah.
Well, over the last year, 10 years, 20 years, however long you've had it,
changed
it
a
may
lot.
have gone from millions down to negative to 100,000, all over to arrive at the point
That it's
at this moment.
Yeah.
Well, where do you stand at this moment in your bank? Where do you stand at this moment in your inventory, your accounts receivable, your credit card debt, your payments that you're making on your trucks and your real estate? It is a sum total of everything at that moment.
Yeah.
And it's going to change with every transaction, but at that moment. So in that regard, it's the ultimate score sheet or scorecard that tells you how your business is done. We can talk about what the numbers are.
Yeah. Okay. So we've got this snapshot of these accounts. Let's walk through some of what these accounts are. Okay. There's 3 kinds, right?
Right.
And those are assets, liabilities, and equity, right?
Right.
So let's just kind of go through each of those and explain what they are. Let's start with assets.
An asset's something that you own from which you expect to get a future benefit. And it can be intangible or tangible. Intangible, of course, meaning you can't touch it. But an intangible asset is cash in the bank.
Yeah.
Now, you can go get cash, but I mean, what you really have is credits on the bank's books. It can be money that's owed to you as accounts receivable. Those are intangible assets. Another kind of asset is inventory.
Yep.
You know, you've got parts and materials sitting out in the shop and in your truck. Those are assets. So assets are things that you own.
Yeah.
Or the company, will say, owns. Liabilities are things that you owe or that the company owes to somebody other than the owner. Mm-hmm. And I'll explain why I said that at the end. But liabilities are your credit card debt, your notes payable to the government for last month's payroll taxes that you haven't paid yet, your bank debt for your trucks, your cars, mm-hmm. or your operating line. It's money that the company owes people outside the business.
Yeah.
So that's assets, liabilities. The third one is equity. Equity, succinctly stated, is what the company owes to you, the owner.
The owner.
So
or the partners.
Everything, all the assets that your company owns are owed to somebody. The company owes them to somebody. If it owes it to outsiders, they're called liabilities. If it owes it to the owners, it's called equity. Equity, it's not really how a balance sheet is prepared, and you don't need to know how it's prepared. Matter of fact, you shouldn't even worry about it.
Right.
But through genius of bookkeeping, it gets prepared. But succinctly stated, equity is the difference between what you own and what you owe to other people. It's what's left over for you. Mm-hmm. Okay. So that's what equity is. So over the years, you've accumulated all these assets, and you've accumulated hopefully not as many liabilities. And the difference between the two is what's left over for you, and that's called equity.
Right.
So those are the 3 accounts. And that's also why they call it a balance sheet. All the assets are owed to somebody, and outsiders are you. So the total of what's owned has to exactly equal the total of what's owed, and that's why it balances.
Right. And that answers the 3 of the 6 questions that we had outlined, really
Mm-hmm.
5 plus the 6th. First one was, am I making money? We looked at the balance sheet for that.
Profit loss.
Or sorry, the profit loss. Then we look at the balance sheet for the next 3, which are what do I own, what do I owe,
right.
and what's left over for me,
right.
which are the accounts there. The assets
mm-hmm.
are what do I own, the liabilities are what do I owe, and then the equity is what's left over for me. Cue the
fire department segment.
Yeah. The statement of cash flows will help us to answer, where did my cash go?
Yeah.
And that 6th question can be answered by any of these on what should I do.
And the 6th question is, what should I do?
Right.
So all of the reports help inform you on what you should do about the future.
Absolutely. So let's get some examples of the balance sheet at work and how it has maybe helped, a business in a specific situation. I know that both of us know Michael Barnett. We had him on the podcast. We'll probably link to that in the show notes, but he had a pretty interesting inventory situation.
Right. Well, and I think we've talked about it before too, but understanding what you own is important. Let me jump back just a little bit. Everybody driving around who's been in business for any period of time has running in their head, I got this much money in the bank, and these guys owe me that much money. If they pay me on time, I got to pay the payroll. I got Friday coming up, plus I got my debt. Anyway, you're always running around doing that math.
Yeah.
You just are. We've all done it. We're all still in business. We still do that. And that is how probably the majority of small businesses run. The owner or somebody in that position are keeping track mentally of what do I own and what do I owe.
Right.
Now they're particularly worried about what do I own that I can turn into cash quickly versus what do I owe that's going to require cash quickly.
Yeah.
And on the balance sheet, those two categories of things are split into sub-accounts. So you have current assets and you have current liabilities. And I'm getting to Barnett here in just a minute.
Yeah.
But the current assets are things like cash. That's as current as you can get because it's
Liquid.
It's liquid, yeah. We didn't use that word yet, but liquid means how fast can it. Liquidity is how fast you can convert something into cash, or negative liquidity is how fast something is going to require cash. So when you're walking around in your business, you're thinking about how much cash you have, which is liquid.
Yeah.
You're thinking about accounts receivable. Maybe you've got some inventory and you say, man, if I could sell that one generator I got sitting out in the shop, that's $8,000. I could get that. But those are current assets, something that you can convert to cash pretty quickly, at least reasonably. And what most people do is you also compare that to your current liabilities. Ooh, I got payroll. That's pretty current, right?
Yeah.
I mean, actually, you don't probably have that as a liability, but payroll taxes are a liability. I owe this credit card debt. Ooh, I can probably hedge on that, but I got to make the minimum.
Got to pay the subcontractor.
Yeah, I got to pay the subcontractor. That's due on the
Materials.
15th, and
vendor.
my vendors are shutting me off if
Yeah.
I don't make a payment and get current, right? So you're constantly going through your head doing that mental gymnastics.
You're balancing things.
Pardon? You're balancing it.
Yeah.
And if you have a good current balance sheet, you don't have to do that because you can walk in, get on the computer, and print a balance sheet on the accrual basis as of today. And look, and there are your current assets and there are your current liabilities, and you can compare the two.
Right.
Okay. What I in fact see, we haven't really talked about the problems yet, but what I see most of the time is accounts receivable or current assets. Right. They're money that people owe you, and they come from invoicing. Finish a job, you invoice. That invoice is an accounts receivable. Well, when we get into books with most companies, and there's a place where you can look to see who owes you what.
Right.
When we open that up for the first time, everybody goes, well, that's not right. That guy already paid me. That number's negative. Why is it? How come it's negative? And I don't know what that is. And Billy Johnson ought to be on there. We invoiced him. So, in other words, they got no idea
Right.
because their books aren't good. If you get your books good, you establish some systems, you can always relieve yourself. You might not like what you see, but you can at least look with certainty and see how quickly or how much money you can come up and how you balance off
Right.
to being able to pay your current liabilities.
And I think this is where also for business owners, when they look at this balance sheet, if it is up to date, they send it off to a CPA or whatever, and they got it figured out, right?
Yeah, and they get
look
it a
at
year
it.
later.
Well, then they go and they look at their balance sheet and they're like, I don't have this money.
Right.
And then you say I just made this much profit. I don't have any money here.
Right.
And it's because it's tied up in a lot of these, not liquid assets, like receivables, for example.
Yeah, and getting back to Barnett, the big issue with Michael, who has his own interview on here, earlier episode, was that he had about $150,000 worth of inventory sitting in his shop,
Right.
which explained why he wasn't as profitable as he thought, because he didn't have it recorded as inventory, he had it as expense. But he still had it.
Right.
It was an asset. He didn't use it. He still had it, but it wasn't reflected on his balance sheet. So when he looked at his balance sheet, he had assets, which is a good thing. I mean, it's a bad thing to have a bunch of inventory sitting around you don't need, but at least you still have it.
Right.
So his balance sheet wasn't correct because his inventory wasn't correct.
Yeah. And now he's solved
Yeah,
that.
he
We
knows
talked
what he's
about
got.
that in the episode, but
Right.
he's got on-time inventory essentially, where there's a vendor that literally sets up shop inside of his warehouse, and has
Charges him for it as he uses it.
for the day. Like he literally scans things out of his shop to put on the truck, and when it goes Actually, it's even it's scanned on the truck.
Well, I'm not sure they've gotten there yet.
But they're about to, where literally whenever the person uses it, that's whenever it's charged.
Right.
So it's really
the best way to handle inventory is not to have it. But
exactly.
Somebody has to have inventory.
Yeah. So I think there's another. You talked about printing out, knowing where you stand, looking at the scorecard, and there's another client that literally does that, right? Where to know where he stands, he sits there and he just prints it off and looks at his balance sheet and knows where he stands.
We had a guy who kind of kept books but got really good at it, and keeps really good books, and he does it himself. He's small enough. I mean, he's a pretty good sized company, but he's small enough in terms of jobs and payroll that he keeps them himself, and he's fastidious about it. And he literally does that. He just looks at his balance sheet and he can see where he stands. And he's we'll talk about here in just a minute ratio. He has what's called a really good current ratio. He has a lot more current assets than he has current liabilities, so he can feel pretty confident. He doesn't have. He's just released the mental stress. And not knowing, and even if you have stress, but you do know, now you know what you have to do. You have to make it you have to make it good. Yeah.
Well, let's jump to talking about some of those ratios, some of those common uses. So we have the current ratio that you just mentioned. What is that? What does that mean? Why is it helpful?
Just contrast real quickly. At its simplest form, a balance sheet is just a list of stuff. Right? It's the things you own, the things you owe, and what's left over. It's just a list. And it's very useful in that because you can look and see what I have in my bank. By the way, what you have on your app, there are not so many checks nowadays, but if you keep current books, it shows you what you really have in the bank if all the deposits and the checks clear. Okay? Not too many people write checks, but people still do. So when you go to your bank app and look, and what the bank says you have in the bank may not be what you have in the bank after all the payroll checks and the deposits that come in later and deposits that you made as checks clear. So the first use of a balance sheet is just a list of information, and it's good information. But the highest and best use of a balance sheet, which most people won't be concerning themselves with today, but once you realize how important it is, you might take a look, but is ratios. Okay?
Right.
So a ratio, of course, is just some number divided by some other number, right? Gives you a ratio. For example, you can have current assets of $100,000 and current liabilities of $50,000, right?
Yep.
So if you divide 100,000 by 50,000, you get 2. So it's 2 to 1. You have $2 worth of current assets for every dollar of current liabilities.
Right.
You say, well, I don't need that kind of stuff. Well, that's the kind of stuff banks use when you take it to them, and you say, hey, I want to borrow some money. Well, they're doing it. I promise you, there's a guy sitting or a gal sitting in the back room working a whole bunch of ratios. So it's beneficial that you understand what banks, is just as an example, regard as important ratios and what good values are for those ratios. And here's why. Banks, they want to lend you money because that's how they make money. But they want you to pay it back. So you have a common interest. You want them to lend you money, and you want to be able to pay it back. So it's worthwhile to understand what banks use to evaluate the health of your company, and that you use those same measures.
Yeah, they're using it for a reason.
Right, they're using it for a reason. And you're thinking, well, I'm not going to go figure out my debt coverage ratio and some other ratios, inventory turn ratios and day sale outstanding ratio. I'm not going to figure all that stuff out. Why would I do that? Well, what I just said.
Yeah.
You can pinpoint places where you have problems, and once you know what the problems are, you can do the things necessary to start fixing them, and then the balance sheet and these ratios show you how you're doing. I have one client, among my favorite, just kept good books, but just an exceedingly bright person, but not trained in this at all. And most of the companies I work with, we work mostly with the balance sheet. I mean, the profit and loss. We want to get sales up, we want the margins up, we want to break even sooner and all this. I don't have that many that we work with on balance sheet ratios, but this client does. And it's a hoot. And one of the things that we look at is the current ratio. Okay? If you talk to a bank, they'll tell you that the current ratio, current assets divided by current liabilities, that 100,000 divided by 50,000, in our example, we said 2 to 1. It needs to be 1.2 to 1 or better.
Yeah.
Okay, that means that you have $1.20 of current assets for every dollar of near-term debt, current debt. That's kind of weak because part of your current assets is your inventory, and you might not be able to get your cash out of that inventory that fast. Part of your current assets are your accounts receivable, and I know that everybody listening is always paid exactly on time by your clients.
Due upon receipt for everything.
And it happens every time. I mean, I know people are going to be laughing at the thought that somebody could actually owe them money past when it was due, but it has happened. So just because you have it in current assets listed as receivables or inventory doesn't mean you're actually going to get your money out of it. It just means you got a good chance of it. Right. So 1.21, having $1.20 of current assets for every dollar of liabilities, kind of weak. Yeah. But that's an acceptable, I mean, banks will look at that, okay? Now here's another one that's pretty interesting. Suppose that you took your balance sheet and your profit and loss to the bank and you made a lot of money last year. 2020 was a good year for you, as is true of a lot of companies, believe it or not, even with COVID.
Yeah.
You go to your bank, you take your balance sheet, and you take your profit and loss to them. You go, man, I need to borrow $200,000 because I need an operating line of credit. And they call you back they don't even call you back. They just send you a message that says ha 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 ha. You go, what the hell? Well, you can make money and you can have a good current ratio, but you may not have a good debt coverage ratio. Okay, so what the heck
What
is
is
that?
a debt coverage ratio?
Debt coverage. You owe X amount of debt that shows up in your liability. You owe $1 million.
Right.
But you have to pay a certain amount on that every month. Your car payment, your truck payment, your equipment lease, your real estate payment, your line of credit payment. Maybe you got to pay $10,000 a month.
Right.
Okay. Well, all debt is paid out of profits. Debt is, in fact, an advance on future profits. So you have to make enough profit every month to pay your debts.
Right.
It's a form of break even. You can break even by paying all your expenses and then start make profit, but still not have made enough profit
to pay your debts.
To pay your debt payments. I'm not talking about paying off the whole $1 million. Just I owe $10,000 every month. I have to make at least $10,000 to have a chance at doing that. And in passing, I'll say you're still not out of the woods because just because you made $10,000 doesn't mean you got paid by those guys or that you didn't buy anyway. But you have to at least make $10,000 or you can't pay off your debt.
Yeah.
I mean, you have no chance at it. So a debt coverage ratio is the same thing. What's my profit compared to my monthly or annual, but we use monthly debt payments. And the banks, again, like to see that at about 1.2, 1.25 to 1. In other words, I make $1.25 in profit for every dollar I have to pay out in debt. Okay. This one client, we are managing by that. We are managing. It's a bit much just to talk about in the interview, but we have a target of 1.5 to 1. Now, they make good money. They make a nice profit. They actually have a lot of cash, but they got a lot of debt. Right. So when we went, and they could use some more assets that they could sell and things like that. So went and talked to the banks about it. The bank came back with a ha 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 ha. I mean, it wasn't that bad, but they said no. So we took a look at it and said, you know what? We're going to manage to a debt coverage ratio that's better than the bank wants, and we're doing it. It affects our decisions. Don't buy this, don't buy that, get that debt down. There are all kinds of things you can do if your debt payments are too much each month. Sometimes you can refinance, roll everything in, extend it. You didn't get rid of any debt, but you reduced
your debt coverage ratio.
You reduce the payments every month and you get your ratio up. Well, I dare say that most people in the contracting business I've worked with aren't thinking about that kind of stuff.
Yeah,
it's a level beyond, but it's a very sophisticated, very important level. There are a couple of other ratios out there that people should be thinking about, and one of them is called day sales outstanding. So the three reasons presaging the statement of cash flows, but if you make a profit but you don't have any money, there are three possible reasons. One is you haven't been paid yet, right? Accounts receivable. I made a big profit, but nobody's paid me yet. The second one is you already spent your profit paying down debt, like we just talked about, or buying assets such as inventory. So you already spent the money that you made. And the third reason is you took it, meaning that you took it out of your company as a draw, not an expense, a draw. But those are the three reasons that you could possibly make money and not have any. So of those, one of the main measures is accounts receivable. I mean, it's huge. Typical company, and I challenge people to look if you have good enough books to do this. I will bet you that at this moment you have more accounts receivable. In other words, you have loaned more money to your customers than you made last year. I mean, I see
made profit.
Made in profit last year.
Gotcha.
So you made $100,000 last year. You got $300,000 of outstanding accounts receivable. That means you loaned all of your profit times 3 to your customers.
Yep.
And we can talk about how that happens. You had to borrow money from the bank in order to lend that much. Anyway, it's insane when you start looking at that. So,
and you're not getting interest on your customers.
Yeah, you're not getting interest. Matter of fact, it's high risk because there's a percentage of it you're probably not going to get paid.
Yeah.
I mean, non-business owners, I love it. People who've never been in business, well, I get paid. Oh, yeah.
Good luck.
Come on.
Good luck.
Come on,
And we kind of talked about our inventory, but inventory turns is another one, right?
Right. Well, just staying with Dave's DSO, there's a method that you can use from your information on your balance sheet of how quickly you turn your accounts receivable. In other words, you give people credit and pay me in 30 days, which is crazy. I don't know why people go with 30 days. I mean, working with big GCs, they're going to pay you when the hell they want, but we'll talk about that too. But you give them 30 days. Well, they pay you 60.
Right.
Okay. So your days, there's an average number out there of how much money you have loaned out and for how long. And I won't go into all the math right now. We've got some articles on it, but if you cut that in half, it's just like freeing up
it's
hundreds
incredible.
of thousands of dollars.
Yeah.
So you start paying attention to that. Well, I can't make that guy pay me. Well, there are things you can do, but one of the things you can do, and this is true of a client that I had, they were delayed by about 15 days before they sent the bill. Oh. And then we also have Jan Reeves on about putting in systems get paid. But inexcusable. People say, well, we bill on the 20th of the month. I go, what the hell are you talking about? You bill at 2 o'clock every day, and then you also bill at 5. Right? Because if it's a 30-day meter, get the sucker started.
Yeah.
Then the question becomes, why didn't we bill every day? Why don't we bill every day? Well, it's too complex. What do you mean it's too complex? Well, guys got to get me the information, materials used, hours. Well, then get it.
Get it. I mean,
right? That's easy.
It's worth hiring another person just to do that.
I mean, depending on the size of your company, but absolutely it is.
Yeah.
I mean, but also, if you know your DSO, you can answer that question. I could save, or I could free up $250,000 worth of cash by billing 15 days earlier.
Yeah.
There's a formula so you can know that number. Okay, we're not just jabbering. Is it worth it to me to hire a clerk to bill every day?
Yeah.
Besides, I'll use them to answer the phone. Well, quite likely it is, because it's not even the cost of the money; it's the fact that you can't do things because you don't have it.
Right.
Right. So, understanding the day sales outstanding, how long your accounts receivable are out there. Then what you just brought up. Another one is inventory turns. Okay. If you sell $1 million a month, and your cost of goods sold is $600,000.
Right.
Right. And you do that every month. I shouldn't have done that. $720,000 worth of inventory turns, cost of goods sold in a year. What's your average inventory? If your average inventory on hand is $720,000, in other words, you have literally sitting out in the warehouse and on trucks $720,000 worth of stuff, and your cost of goods sold for the whole year is $720,000. You've turned your inventory once. Make sense?
Yeah.
Right?
Makes sense.
If I have $360,000 worth of average inventory on hand, but I generate $720,000 of cost of goods sold, I've turned my inventory twice.
Right.
What if you could turn it 10 times?
It's
Right?
just less
You'd have
cash.
72,000. Well, it's efficient.
It's efficient. Less cash tied up.
It's less cash tied up, but also when you have less inventory sitting around, you got less theft, you got less damage from a forklift driving over it.
Right.
You've got less risk that it's obsolete. Oh, well, we want the new model. Well, I've got the old model. Well, I'm only going to pay you half for the old model. So there are a lot of reasons not to have inventory. There are a lot of reasons to have inventory, but to manage it properly. Well, how are you going to manage it properly if you don't have a scorecard? The scorecard to begin with is how many times did I turn my inventory last year, and how are we doing this year? I'm going to get better at it. And you do twice as well, and then you do 3 times as well the following year. And those things are management that really extend beyond just, did I get the sale?
Right.
And that's where you're really starting to get the squeal out of the pig, and that's balance sheet stuff.
And with that inventory, that's where a lot of people will say, oh, wow, I'm going to get a 10% discount or 20% discount on the inventory, and they tie up all their cash.
Absolutely.
And then they're not even able to do sometimes probably a turn in a full year.
Yeah.
Because they're holding on to so much inventory that they bought that they don't even go through it in a year.
Well, we've talked about it before, but profit and loss and making money in the form of a profit in a business and cash management are related, but they're 2 different things.
Yep.
And we'll get more and more into it with the statement of cash flows. But yeah, I see that all the time. If I buy 5 of those, I get free freight. Well, I need 3.
Yeah, I don't need 5.
Well, I'll use them. Well, go visit Michael Barnett's old shop. They don't even know they got them, right?
Yeah, you forget
and
about it.
if they do track them, then they would know they had them on their balance sheet. But anyway, what do we have that for? So even though you can save a few bucks on freight or maybe quantity, that's another position when you get to the right size as purchasing agent who can buy economic order quantities and figure that out, but have minimum inventory levels, not just buying stuff on the spur of the moment because the salesman's on the phone. He goes, man, we're having a special. Oh, give me a bunch of it, or I'm going to use it anyway.
I think as we talk about, this is what the Wall Street guys use is the balance sheet and the profit and loss statement. And as we've gone through this series, I know a lot of contractors are thinking, man, I still over my head and this is a lot to think about. And I think if you can just take it step by step, it'll go a long way. And if you think about these Wall Street guys, they all have finance degrees. And this is all they focus on. It is a full-time job. And so you've got to find somebody in your corner that can really help you think about these ratios, think about, the health of your balance sheet, the health of all of your financial statements. And if you think about it, it's where you're going to become a better manager, a better owner, a better operator, because every single one of these private equity groups that goes and buys a company, they're looking at this and they're looking at these ratios and saying, hey, how can we get that days sales outstanding down, right? Is it just an invoicing problem? Is it a terms problem on our invoices? Is it an issue about getting the invoices out or follow-ups? That right there, if they can fix just that one thing, can change the health of a business, and it can make that business worth so much more. The current ratio, all those different things. That's what they're looking at, and they're looking for businesses that have these errors where they're like, oh, we know how to fix that. Let's buy this, turn it around in 6 months, and completely change the value of the company. And so just understand that if a private equity group can go and do that and change the valuation of a company, you can go and do it if you have the help.
We'll have episodes on that in the future of how to literally do that. But
absolutely.
Most of the guys driving around, I know from experience. I guess I don't know who's listening at this moment, but I know from experience. Many small business owners don't believe their companies have value beyond real estate equipment inventory. Right? They don't believe it.
Yeah, because they're stressed out. They're like, who would want this?
Yeah, literally, I hear that all the time. Who would want it? Because they're going crazy.
Yeah.
Well, your business does have value. You give yourself credit for everything that you've done to get where you are. You had to get a phone number, had to get a name, had to create an LLC, had to get some customers, you bought a truck, kind of figured some things out. Hopefully you've hired a couple of people and begin to leverage yourself. Maybe you've hired 150 people. By the time you get to that size, guys are starting to think, my business does have value.
Right.
But we'll have a whole episode on what it takes to maximize that value. But
well, and a lot of guys I think it's also helpful to understand these things as you think about growing. I'm sure there's contractors out there that have thought about buying out another company locally, swallowing them up and bringing them inside. And if you understand this stuff, you're really going to see the value in some of those things rather than trying to hire, 5 new sales guys or pour a bunch of new money into marketing or whatever it is to try to grow your business. Sometimes it's a lot easier to just go and find a company that's stressed out, tired, doesn't have the systems in place, but they have business that you can go and buy, and you can fix all the problems by just putting in your systems.
To understand.
And now
it
you've grown
depends
through
on which
acquisition.
one's my client, the buyer or the seller.
Right.
But you're exactly right, because that's the whole point of all the financial statements is they tell you what the score is. Mm-hmm. They pinpoint where the problems are and give you ideas of what to do to change it. And then they show you how your changes are working. So we've been talking about a lot of things on financial statements, but maybe your thing is cash flow. Maybe you've got 5 times that. Go look.
Yeah.
Go look. And I'll be interested. How do you know what people owe you? If you have good books, you click on the accounts receivable and look. But how much do people owe you, and how much money did you make last year? Mm-hmm. I will bet you it's at least 3 times that amount you've got loaned out.
Yeah.
And that's what it is. You've loaned it to your customer.
Yeah.
Lent
it to your customer.
Lent it to your customer. The loan is the thing.
So,
not the verb.
The next episode that what we're going to be talking about is the statement of cash flows. But we can't talk about that if you don't have an accrual-based balance sheet. Why is that?
Well, the statement of cash flow takes information from your income statement. The statement of cash, presaging the next episode, is really simple when you get it, but it's really hard to get it. Based on my own experience and the experience of me trying to explain it, I have a shortcut that makes it really easy. But once the light bulb goes on, you're going, duh. It's so simple.
Right.
But it literally shows you exactly where your money went. And so it uses information from the balance sheet. And think about it. Some of where your money went is that you lent it to your customers, right? Mm-hmm. So that is a non-cash item that will only show up on an accrual-based balance sheet. Right. But it shows up on the balance sheet and only on accrual. Remember, cash, it wouldn't show up because cash basis doesn't count anything until it's settled.
Right.
So you need an accrual-based balance sheet for things like assets and accounts receivable. And you need an income statement because the amount of profit that you make or loss that you lose or also contribute to your cash. So you need both those two things
to be able to do the statement.
Otherwise, there's no such thing as statement of cash flow. It uses information from those two to tell you where your cash went.
Right.
That's really important.
Absolutely. So make sure that you have your balance sheet, that you have your profit and loss all in order before trying to look at a statement of cash flows, or you're really going to be lost. You're not going to be able to really.
And we'll reiterate. If you have books and all you do is need to make some modifications, make sure they're current. You're making current entries. Make sure that you clean up your accounts receivable. If that guy doesn't owe you, then you get it off. If that guy does owe you, make sure it's on there. Those kind of things. If you don't have good books, if you're operating off your bank statements and stuff, it's not you. You're not going to do it. You don't have time, and you won't be very good at it. You'll get frustrated, and it won't happen. You have to get a qualified accountant or a really good bookkeeper.
Yeah.
And really good means they understand more than just how to use QuickBooks. They have to understand these things we're talking about.
Right.
Get them to do it for you. Then you pick one. You don't have to track there are a lot more ratios, a lot more. You don't have to track all the ratios, but you pick one.
Yeah.
If cash flow is a problem and accounts receivable is a problem, then you start tracking your day sales outstanding.
Yeah.
And see if it goes from 60 days to 45 days to 41 days, and you track it. And you have to have good books to do that, but it's not up to you to set it up.
Absolutely.
And you shouldn't even have to do the ratios. Tell your accountant you want the ratio every Monday morning.
Absolutely. And another thing is start building a relationship with a banker if you don't have one, and ask him these questions. Hey, what are my ratios, and what are you concerned about? If you were going to, because they're trying to look for healthy businesses to lend money to.
Right.
And so they're going to be able to distinguish if you're a healthy business or not. And you can ask them, hey, why am I not a healthy business in your eyes? And that's just going to help you right there understand things from an outsider's perspective.
That's a really good point. Your stock will go up in the eyes of your banker. They're
They're
not going to loan you money unless you got collateral.
Exactly.
But your stock will go up if you ask those questions. And I say in my book, ask your banker what ratios they're looking for.
Yeah.
And if they won't tell you, go find another bank.
Exactly.
Because that's what they do. And you have a common interest.
And they're also, sometimes that's a really good place to start because they do know the accountants that are good at this stuff. Right. They do know the bookkeepers that can help you because they've had to do it before. They've helped other businesses get loans by cleaning up their books, making sure that every statement was accurate, knowing the ratios, because they're not going to lend money to companies that don't have these things in order. And another thing I will mention, that if you're smaller and you're like, man, we're just not big enough to where this stuff even matters, that's not true. Yeah, maybe you're not going to be going and getting financing for millions of dollars to buy equipment or whatever it is just yet. But the smaller you are, the smaller these problems are to fix.
Well,
now.
That's an interesting point. But that's the point of ratios.
Yeah.
That's
ratios
what ratios do. They make, so you have 100,000 of current assets and 50,000 of debt. That's 2 to 1. You can have $100 million worth of current assets and $50 million worth of,
and have the same ratio.
and it's 2 to 1.
Yep. That's
the important thing, and that's why a bank can say we're looking for 1.2 to 1 debt coverage ratio. Okay, well, I don't care if you're Devon Energy, which is a huge energy company here in Oklahoma City, or you're Mr. Mom and Pop AC plumbing and electrical service.
Yeah.
The ratios, and get to know what good ratios are, kind of have them in your mind. They guide your decisions.
Yeah.
They guide your decisions. If I'm trying to get the DSO down, you know what? I've got to do this. I got to bill promptly. I got to call that guy. I got to have a system, Jan Reeves system, where we follow up automatically and say, did you get the bill? Did it go to the right person? Did everything look all right? Anyway, you just do these things that get the time down.
Yeah, absolutely. Figure it out now, not later. Don't say, oh, they'll figure it out after this job or whatever, or whenever I get this many employees. No, go do it now and set in place the habit of looking at the balance sheet, of having those things in order, because it's only going to get harder if you wait.
Hey, I want to point out one thing on the balance sheet. People understand assets. People understand liabilities. But you get to equity, there are all these things. Equity just kind of sits there on a balance sheet. There'll be things like opening balance equity and owner's contributions and owner's withdrawals and retained earnings and current earnings. Well, a lot of those things, it's kind of obscure how you got there. Accountants made the entries. Anyway, but there are 2 numbers on there that are really interesting. And they're the last 2 right before you get to the very bottom of a balance sheet. And it's retained earnings and current earnings. Retained earnings, when you get a good balance sheet, tell you how much your company has made from the day it began up until the end of last year, December 31st of last year. Current earnings is how much your company's made from January 1st of this year to today. At the end of this year, current earnings gets added to retained earnings. Current earnings goes to 0 and you start over again. But that number is always fascinating. You just look at it. Yeah. Now, if you haven't kept good books, the number might not be there.
Right.
But when you've kept good books, you go, wow, I've made $30 million over the last 15 years. Had no idea. Yeah. So that's really interesting.
That's good.
It's a fun number to know.
Well, this was part 2, well, really part 3 if you count the overview of our financial statements piece. And so we will be going into the last part of the series, the statement of cash flows. Again, check out The Profit Problem, Martin's book. It'll be in the show notes. Yep. It goes through all of these things in greater detail with excellent examples where you can clearly see what the balance sheet looks like, how to read one, what ratios to look at, all those kinds of things. So there's that for more information. And then follow us on social media. Give us a shout out. Share us with your contractor friends, subs, GCs, whoever it is. And we would love any promotion that you can give us. And really enjoy doing this. So thanks for listening. Martin, appreciate your time.
Hasta luego.
See you next time.
Thanks for listening to The Cash Flow Contractor. Check out our website in the show notes or visit thecashflowcontractor.com.